Good morning again. Thank you all for joining us as well. I see some questions coming in, and we will answer those as we go through the presentation this morning. So I just want to kind of start off with just a reminder of a time in my life. And back in September of 2001, I was kind of starting new again. I opened an office and started a new office over on Hirschburn Lane, Mercurio and Associates Inc. at the time, and was really super excited to get started with getting back on my own business. I'd worked with another company for a period of time, and then it was going back out on my own again. I'd signed a new 5-year lease, hired my first employee, had utilities, had expenses, and was really an exciting time for me to get going. But really just 7 short days later, that would all change. On September 11th, I was in a dentist appointment in Shelbyville and came out, got in the car, turned on the radio. WHAS radio was reporting a plane had just hit a building in New York. And at the time, they were saying that it was really just a horrific accident. And but we all found out later that it wasn't. And by the time I reached the office in Louisville, the second plane hit the other tower, and then they started reporting that we were under attack. I had no idea at that time how my life had just changed, or in fact, how the whole world had just changed. In a matter of 3 or 4 hours, everything changed, and I felt like I never felt so out of control in my life. And I think over the last 2 months, a lot of us have experienced that same feeling. We've kind of felt like, what's going on? How do we respond to this? How do we react to this? And what we're going to talk about in the next 25 or 30 minutes or so is some ideas that I think will help you maybe reorganize and get positioned so that that you are going to be okay. So I appreciate everybody joining us today, and I think that's the message or the goal for this morning, is really just making sure that we can distribute some good information to you. So before we get started, like always, I got to show a disclosure, and just letting you know that what we're going to talk about today, we're going to talk about some financial products. We're going to talk about some tactics and things like that. I can't offer any guarantees. I can't offer any sure returns or anything like that. Everybody has to apply this situation or this information to their own situation as you need to or as you can. And just make sure that you're doing your own research. And if you need help, then obviously we're here to help you through that. If you'd like a copy of this disclosure, popping it up here pretty quickly, but if you'd like a copy of it, we can send it to you. So one of the things that I think we're all concerned about today is just that there's a whole host of things, including the market. And when we start talking about this, what I'm going to try to do is offer some concrete questions, some ideas, and some things that you can apply to your own situation, and hopefully change that situation a little bit. Because whether you're sitting in front of your TV, whether you're sitting in front of your computer, you're scrolling through your phone or whatever, uncertainty is all around us. And that's what we've had to deal with for the last month and a half or 2 months. On March 9th, that was the beginning of the 2020 stock market crash. We saw at that point the largest point plunge in the Dow Industrial Average in U.S. history. That day was followed by 2 more days. On March 12th and March 16th, we also saw huge drops in the markets. Over just a few weeks, the market dropped approximately 37%. And one of the questions that kept on coming up was, should I stay or should I go? In other words, should I ride this thing out, or should I bail out and go to cash or do something else? On March 23rd, the Dow hit the bottom at 18,585. And since then, it's recovered about 6,000 points. Now, my numbers are going from January 1st through April 30th. So during that time, the market's down about 16%. And every day, we're having, we might have a good day, we might have a bad day. Today, it's a little negative. But the real question that myself and colleagues that I have and people that I'm talking to, what we're wondering is this what's called a dead cat bounce? And what a dead cat bounce is where we have a small recovery over a period of time in the stock market or in a stock itself, and it looks like everything's good, but then maybe it isn't. So what we're really trying to figure out is that what we're experiencing right now, or are we truly on a recovery? So hang on a second, got one backwards. Yep, there you go. Did I miss that? All right, so what I want to talk about is really the state of the economy. So I guess the bad news first is that most reputable economists, investors, cyclical experts, billionaires, they're all saying that a recession is probably our best case scenario out of this. And in fact, they're looking at, probably more like heading into a depression. And I'm going to try not to be, a doomsayer here, but I'm just trying to state some facts here. The good news is that I think we do still have time to reposition ourselves and get things organized and make sure that we're okay. And I've heard a lot of comments out there. People are saying, well, isn't everything going to go back to normal after the virus is under control or after the lockdown is over? Aren't we going to just get back to normal, whatever that new normal is? Unfortunately, I think that's what I'm hearing from most people that are saying, I need to stay put, or I'm going to stay put. That may prove to be a critical mistake at this point, because I do think that we are going to see a lot more volatility, if nothing else, and probably some new lows tested. So again, that's kind of what I want to make sure that we're talking about today. Now, most of you on the call are already working with us in some form of another. So you're either working with me or Nick or Troy or Andy. And one of the things I'm going to encourage you to do after the call today is, schedule time. If you're concerned about something, you have a specific question, how we're actively managing your account or whatever, I want you to pick up the phone, call in, and schedule time for us to sit down and talk with you, whoever your advisor is, and we'll spend 10, 15 minutes on the phone and just kind of talk about that. At the conclusion of the day's session, as Zach said, you're going to get an email from him, and it's going to offer a 15-minute phone consultation with me or one of the advisors here. And I'm going to encourage you to do that. If you're not one of our clients, I certainly encourage you to do that. But if you are and you still just have questions, we want you to take advantage of that kind of wrap-up call and make sure that everything is good for you. Keep on clicking too fast, sorry. All right, well, this slide, it really depicts something that I think a lot of people are experiencing. And it really, it's no wonder that everybody's concerned about where the market is. I mean, if you ask 5 people right now, you're going to get 5 totally different answers. Some people are saying, hey, just hang in there, it's ride this thing out, and maybe that's a good thing for you to do. I don't know. But we've taken a little bit different stance. The problem is, and quite frankly, if somebody's telling you they can predict what's going on, it's probably, you need to probably get some kind of an eerie, suspicious feeling at that point. I'm not trying to predict what's going on. I just know where what things look like. So I'm trying to be very cautious, and we are taking a pretty conservative stance in making sure that we're protecting our clients' accounts, your monies. We want to make sure we do that. And in fact, I mean, we are totally in uncharted water here. We've never had a global pandemic where it's shut down all markets, not only in the US, but across the globe. So it's really hard to see how this is really going to impact everything. So we want to make sure that we are being cautious and that we are being proactive, that we're doing something if we have to, or we're at least making sure we are. The worst thing I think you can do, and I've heard people say this a few times too, is that, I'm not even opening my statements anymore. I don't want to see how bad it is. Well, that could be a pretty bad mistake. So all the information that's flying at us, it makes sense to try to figure out what we need to look at, what factors do we need to consider, and how are we actually looking at those. So I've kind of come up with 5 different key factors I think that we need to look at and just see how things are going throughout this pandemic. So the first one is the speed in which the market dropped. And we'll talk about that. The second is the potential for the market to drop even further. The third is the skyrocketing unemployment numbers. We'll talk about how that's factored into this. Fourth, we're going to look at the impact of the pandemic over several key industries and the economy overall. And then fifth, how is the virus going to continue to spread, or will it continue to spread? Did it again. Nope. Here we go. All right, so the first variable is the speed in which the market really declined. As I said before, it took us about 22 days for the market to fall over 30%. And that record high was reached on February 19th. And then, as I said before, we started to crash and the bottom hit around March 23rd. So when you look at the history, Bank of America Securities put out this graphic that says that the market just fell faster than the 3 previous times that the market had fallen 30%. And those previous times were in 1934, 1931, and 1929, respectively. In other words, none of us listening today, or none of you all listening today, and myself included, have ever experienced the investing world drop in such a fashion. The closest we ever came was nearly a century ago in the worst market decline in U.S. history. Now, I'm not saying that we're in the same time that we were back then. Obviously, there's a lot of things that have changed since then. We got a lot of technology and everything, but that could even increase or change the velocity of this. So when the market crashed in October 29, it didn't stop until 1932. And the Dow Jones ended up falling about 89% during that period of time. So when you think about that and you think about your retirement savings, it becomes critical to consider a second factor: how much further could it drop? So if we drop 30% so far, could we potentially, go down further? Could it actually, drop even further than it did before? And then you have to consider, if it did, or does that leave you from, where you started from? So one of the things that many people misunderstand in the market is how much of a return does it take, or a gain does it take to recover from a loss? So mathematically speaking, losses hurt a lot more than gains help. And as an example, let's say you had $1 million when all this started. You lost 50% of it, so you're down to $500,000. Many people think that if you had a 50% loss, then obviously you need a 50% gain to get back where you started from. Well, unfortunately, that math just doesn't work out. I mean, you actually need quite a bit more than that. So when you think about it, if you had a 500% or 50% loss, now you got $500,000 in your account, and you got a 50% gain, that's only going to leave you at $750,000. So you're well short of where you actually began. So we actually have to have more like 100% recovery to get back to the $1 million. And the question that you need to ask is, how likely is that to happen? Number one, and how long will it take to do that? If I'm citing the depression in 1929, it took over 25 years to recover that 89%. Now, again, we have a much different market than we did before. So I'm not trying to be that alarmist, but I am trying to make sure that everybody understands that there is a correlation here, and markets work in certain ways. And some of you listening, I mean, heck, I'm 59 now. So getting, 60, 70, 75 years old, you have to ask yourself, do I have enough time if we had a significant loss? So many of you guys may recognize this guy. This is Warren Buffett, one of the most famous investors alive today, currently the 4th wealthiest person on the planet. He's known for his market savvy. He's amassed a net worth of $70.5 billion. So what's he say about the incurring market losses and how to deal with that? Many of you all have heard me quote him before. You've heard this not only from me, but from other people too. Mr. Buffett's number 1 rule in investing is never lose money. And his number 2 rule in investing is remember rule number 1. Because as we've just seen, losses hurt so much more than gains help in many cases. It takes a lot to recover from a significant loss. Buffett's always understood that, and he tries to make sure that whenever he makes a bet, that he has some way to recover from that, or he has a way to pick up money from that. He also recently said, it's insane to risk what you have for something that you don't need. In other words, the 4th wealthiest man on the planet is not a big fan of taking on excessive risk. So particularly when it comes to something that that's not required to reach your end goal. Many of you have gone through the planning process, and we know what it's going to take you to get to age 95 or age 100 and still have money left. So trying to take excessive risk to just pad that doesn't necessarily make sense, and at least in Mr. Buffett's eyes. So what we want to try to make sure that we're not doing is taking on too much of that risk. Looking at his comment, one of the things that we have to really understand is if it means that if you can live the life that you have or that you want or desire in retirement now with what you have without taking on more risk, then you probably shouldn't take on more risk. I guess many of you probably have had a pretty good run over the last decade, or we all have had a pretty good run over the last decade, and it could be time just to take some chips off the table. So one of the questions I had earlier was, is it time to cash in things? I don't know that it's time to cash in. We're going to talk about that here in just a second, but I do think that it's time to look at how to reposition things to make sure that you're not, taking major hits. So the third factor that we're looking at is the alarming rate of unemployment being caused by this shutdown. 16.8 million unemployment claims came in between March 15th and April 4th. That's translates into more than 1 in 10 workers seeking unemployment benefits. According to the director of Economic Policy Institute, we are nowhere near the end of this, and the labor market has been upended. That's a quote from her. So one of the things that I think we have to consider is how fast is this going to rise? The previous record for unemployment was just over 700,000 claims filed in a single week back in October of 1982. That means that the recent week ending April 4th was nearly 9 times higher than the previous record. In fact, weekly unemployment claims numbers now are climbing so rapidly that the White House has reportedly asked state officials to delay releasing precise counts. And I've got the quotes on that if you would like to see those. So we want to make sure that we're at least factoring that in. Economists at the Federal Reserve project that the total unemployment could reach 32.1%, totaling about 47 million people. Now, 47 million people, that's roughly the equivalent of the residents in New York, Florida, and Colorado combined. So unemployment doesn't look real good, and I think that's something that we have to factor in. Well, what about the global economy? How does it stack up with that? Our fourth variable is the impact on the outbreaks had, on major industries worldwide. The retail industry, which is responsible for about $2.6 trillion of the annual GDP, which is about 25%, has nearly ground to a halt. Hospitality industry is losing roughly $1.4 billion a week. The travel restrictions in place are keeping them down. According to Reuters, global airline estimates, their 2020 revenue losses are going to be about $250 billion as planes sit idly on the runways. Buffett himself actually Buffett himself just recently sold all of his industry or all of his airline industry stocks, announcing that the world has changed for the aviation industry. He did this in his address to shareholders at the Berkshire Hathaway annual meeting just on Saturday. He's also setting on $50 billion. One of the questions that came out during that shareholders meeting was, Mr. Buffett, you got $50 billion sitting in cash from cashing out your airline stocks. What are you going to buy with that? And he actually said that right now he doesn't see anything that's of value for him to reinvest that money. One of the other quotes that he's said many times is if everybody else is greedy, then you need to be fearful. If everybody else is fearful, then you need to be greedy. So I think what he's seeing is that as the market continues to go up, he's seeing that as a sign of greed. So he's just content with sitting on the sidelines. Now, I don't think that we have the ability to sit by idly and have everything in cash. I think we have to maintain some growth in our portfolios, trying to pick up what we can. But what we're trying to do here as a firm and you all have seen us do this in your own portfolios, is we've taken positions where we've got out of the market for a little while, then we got back in. And I think that's how you have to be ready to do this. Skipped again. And hang on. Bear with me. Making sure I don't skip any slides. In the U.S. right now is, I guess the next factor is really how is the rate of the virus going to continue to spread. So the U.S. now is has the highest number known of the corona cases. We have actually surpassed China and Italy. There are currently, as of April 30th, a little over 1 million cases in the U.S. alone. Those numbers, by many accounts, are surely going to be very conservative, as people in many states struggle to even get tested. Now, I know that some of the testing is starting to pick up now here locally. Epidemiologists at the University of Washington predict that we could lose as many as 80,000 Americans by July. So I think that that's something that we have to really consider, is how this virus is being contained and how we're going to be able to, control it going forward. To put that in perspective, and you look at it in comparison to other outbreaks in the past, SARS and H1N1, the SARS claimed about 774 lives worldwide. None of them were in the U.S. H1N1 in 2009 killed about 12,469 people in the U.S. So the death toll in just the next few months is anticipated to be about 6.5 times that number. So we definitely have some work to do on getting this under control. So those are the factors that we've been considering, or those are the things that we're watching, and it's completely unpredictable right now. So it's what we can predict, though, is that we have to make some changes, or we have to protect our financial futures going forward. And the reality is the only thing that's relatively certain right now is uncertainty. So while we're dealing with this pandemic and looking for it to end, what the best thing that I think we can do is start planning for the worst and hoping for the best. What's that mean? It means that you need to do what you can to protect your retirement savings, make sure that everything's buttoned down so that we're going to be protected going forward over the next, I'm thinking 18 months or so, that we want to be protected for that. So let's focus on three main things that we kind of came out of this. And what are your options with this? So number one, first option is that you can just currently just stay invested in the market. Simply leave it alone. And you've heard people say in the past, you've heard other brokers say, you've heard people say that their advisors have told them, just ride it out. Don't sell out. You'll lock in losses. All of those phrases, just weather the storm. And for decades, many advisors have actually advised their clients to do this. The problem, as we've discussed, is that there's no assurance that, number one, that we're at the bottom of this, and number two, that the rally is going to continue. So we have to be sure that if the market did fall another 20 or 40% on top of the 16% that we're down now, are you going to be able to survive that? And if you started with $1 million in your retirement account on March 8th, and now you're down to $400,000 or $500,000, could you still maintain the same lifestyle that you had prior to that, or would you feel comfortable maintaining the same lifestyle without going back to work or doing something different? So that's option one. Option two, well, is simply to sell off and go to cash. Sam Hazard just asked that a minute ago. Should we actually do that? Should we sell out and get out and then go to cash? As most of you know, we've taken this track ourselves and I think it was around March, I want to say March 21st or 20th or something like that. We started moving people to cash in our portfolios, 20% first, and we went to 50% cash. Then we got back in about 2 weeks later when the market started to bounce, we jumped back in. So the problem I see with going to cash is that most people that have tried this in the past, and I've talked to dozens of people since 2008, that sold out in 2008 at the bottom and never got back in. So the problem I think you have if you're trying to do this on your own is that a lot of people just don't know when to try to get back in. I talked to a gentleman just last night, and he said that he had fired his advisor about a year or so ago and just kind of started taking over on his own. And one of the things when I was going through his reports with him, I just asked him, I said, so how are you doing? Have you been able to manage the portfolio properly? And he said, well, I really haven't made any changes. So he admitted that he didn't like what the advisor was doing because the advisor was being too conservative for his liking, but he also admitted that he really didn't have an idea of how to do it on his own. So I think going to cash maybe not the best option for all of us or for all of our portfolio, certainly, but that is option number 2. So if staying put's not the right answer for you and completely going to cash is not the right answer, we do have a third option here, and some of you guys have seen this before, okay? The third option might be something like a fixed indexed annuity for some part of your portfolio. So many of you that are on the call right now or on the webinar right now, we've positioned some of this in some of your retirement savings in this type of a vehicle. And to be quite honest, I've talked to many of you. You're pretty happy with that part of the portfolio because it hasn't lost a dime during this downturn. Now, I can hear what you're thinking out there. A lot of people say, well, annuities are expensive. Annuities tie my money up, and I don't like annuities or whatever your comments are, whatever you've read online. So let's talk about them for just a second so you can understand exactly how these vehicles work. First and foremost, fixed index annuities, or FIAs, you'll hear me call them that. Your principal is completely protected by the financial strength of the insurance company that writes the product. So if you pick a good insurance company, more likely everything's gonna be good. I've been in the business since 1986, and during that time, I've only had one insurance company that I even heard of that went out, and that was Kentucky Central Life, when they made some outlandish promises of when the interest rates were crazy back in 1980. The policies they wrote back in 1980 were really high, interest rates were really high, and they guaranteed those interest rates. So insurance companies have a different reserve requirement than banks do. So they have to maintain at least $1 for every dollar of liability that they have on the books. So you have some extra surety there. So how do these things earn their interest, or how they earn credits? First of all, they're tied to some index. So they might be tied to the S&P 500. They might be tied to the NASDAQ. You're not directly investing in the market, though. So it's not like a variable annuity. A variable annuity has mutual funds inside it where you're actually investing inside the market, so you can lose money too in the variable annuities. But in the fixed index annuities, the interest credits are based on the market's performance over a period of time. Maybe it's a year or 2 years or what have you. Your principal's protected by the insurance company. So when the market goes down, the worst case scenario is you go through a year without making anything, but you don't lose anything. You don't lose what you made the year before, and you really kind of set yourself up to go forward because you reset when the market's at a lower point, and you can earn a little bit more as the market recovers. So another way to look at that would be, let's say when everything is over, we take a trip out to Las Vegas, or you go over to one of the gambling boats, and you sit down at a blackjack table in the casino. So the blackjack dealer says, okay, here's the deal with my table. We're going to deal a hand, and you're going to put your chips out here. If you lose, then I'm just going to reshuffle the deck and redeal the chips, or redeal the cards. No chips are lost at that point. But if you win, I'm going to keep 50% of your winnings. So my question to you is if you could sit down at a blackjack table and you knew you weren't going to lose anything, but you were only going to win 50% of the money that you actually were entitled to win, how long would you sit there? Most people would say I'd sit there all day long. And the point of that is that if you can't lose, then that's what this part of the portfolio could do for you. And again, many of you already have this in your portfolio, so it's doing exactly what it's supposed to do right now. It's protecting that asset. It's protecting a big part of your portfolio. I've talked to, again, many of you guys on here and a lot of our clients. During the worst part of this, their portfolio was down maybe 4 or 5% total, because their stock part of it might have been down more, but their annuity portion was protecting the rest of it. So this might be an option for some of you guys. And I'm not saying that you would put everything in it. You certainly wouldn't do that. We use this as a way to make our portfolios more conservative. And again, we call it a core holding. So it's just part of your portfolio that's out there. You're not being charged a management fee on that or anything like that. But you are protecting a good portion of your portfolio. So that's option number 3, or might be an option. So one of the things that you're going to see with this is, or a couple of questions that might come out of this, is that, would I rather, do I need to have every penny to recover from the market when this pandemic ends, or and do I kind of pair that with potentially losing another 20 or 40%? Am I okay with, setting a little bit closer to, or being a little bit more conservative as we go forward on this? And I think that's what that's where the discussion that we would need to have with you to make sure that this is something that would fit for you. So none of us really know what lies ahead. There's this gentleman is the chief investment officer for Guggenheim Investments, and he recently said at the CIO Outlook symposium that I'm not betting on a global depression, but I'm saying that for the first time in post-war era, we're really too close for comfort. So when a CIO of a global investment firm that's managing over $270 billion says something like this, I tend to listen to that. I have to make sure that we're taking an approach that's not going to put you guys in harm's way. The road ahead's definitely going to be bumpy, and one of the things that we know is that a lot of this is out of our control. So one of the things I've always told my kids, and you all have heard me say this, is that I want you to stay in control. I'd rather you be in control of things. So we need to take control of the things that we can take control of. And by doing that, I think the first step is really understanding where you are currently. Well, businesses all over the country are starting to reopen. Ours is virtually 100% open. I mean, we've been here the whole time. Myself, Karen, Zach, Alyssa have been in here most of the time. The other advisors have been working remotely from the office. So if you have time to meet with us, we can set up a 15-minute phone call or a virtual meeting. We can go over your reports. We send it to you via computer, and you can log in. We do just exactly what we're doing today. We'll do like a virtual meeting, except for you're the only one on the call. You get an email and log into it. And after today's webinar, you're all going to get that email that Zach was talking about. Really, number one, just thanking you for being on here. And I really do appreciate you taking time to get on here this morning. But there's a direct link to our calendar. So if you'd like to schedule a time with me or one of the advisors, click on that link. It's going to go directly to our calendar, and you can pick a time, and then Zach will call you back and confirm all that with you to make sure it all works and send you the appropriate information that we need. So I want to leave you with one last quote from our friend, Mr. Buffett. One of his famous sayings is that, when it comes to the market, is you never know who's swimming naked until the tide goes out. In other words, many people don't realize how exposed they are to the risk of Wall Street until the market crashes. The good news is that I think we still have time to make sure that we're protecting it what we can, and we can be a little bit more diligent going forward. So with that, again, I think it's really time. I want you to have a cup of coffee. Hopefully we'll get together soon and we can have a cup of coffee again together. We've got a couple questions on here. Let me see if, so I got a question, just an anonymous question here. It says, if most of your money is in annuities, are you safe? And I guess the answer would be, it just depends on what kind of annuities you're talking about. Some annuities might be those variable annuities. They're directly invested in the market. If they're in the market, then you may not have 100% safety there. So you have to make sure it's the right type of annuity. And again, I think that brings up a lot of other questions, in my opinion, is that annuities do have some quirks to them. You have to understand how they work, and you have to understand that there are some bad ones out there. There are some good ones out there, just like in any investment. So you just have to make sure it's going to work for you. And one of the reasons we developed the planning process that we have here now is we make sure before we ever engage with somebody, whether that first and foremost that we're a good fit for them and they're a good fit for us, and that we, that before we make any recommendation, we want to make sure that we have a lot of information about their current situation. Another one says, have very conservative investors been impacted less? I would say it just, again, I guess it depends on what you're defining as very conservative investors. What does that mean? If you're conservative and sitting in cash, so certainly that you've been impacted less, but you probably didn't have the growth that the person that was invested in the market had over the last few years. So that's, again, something that you have to kind of consider. How are you invested in the first place? Is it a good time to buy precious metals? We have precious metals in a lot of our portfolios. I think we've basically have been doing that for a while. We haven't started overweighting them yet, but that's not something that we've taken off the table. And let's see. What about money market funds? Money market funds are just like an interest-bearing checking account. So basically, if you've got a savings account at the bank, you're probably getting interest on that savings account. The money market is just maybe a little step ahead of that. In 2008, I think that was the first time money markets had ever lost money. Right now, you got to consider we are at a 0% interest rate. So the Fed has done everything they could to kind of to stop this. My fear is that with the printing presses running at 24/7 in the Fed central banks throughout the country, that what's happening is we're flooding the market with new money, which probably is going to meet inflation in the future. And that's another factor that I'm very concerned about. Let's see. Somebody commented, having annuities have made me less anxious during the market fall. And I think that's a common thread out there, that a lot of people feel like that if you've got money in annuities, it makes them feel a little bit more safe or a little bit more comfortable about all that. All right, guys. Some other questions in here, but I'm not going to take time to answer all of them. I'm going to try to answer them back to you individually if I got your name and email address in there. If you have any specific questions that you want to address to me, feel free to email me or Zach, and Zach will make sure that I answer the questions and get it back to you and everything. So again, thank you all for being with us today. You're going to get an email right after this, and that email is going to give you a link to join us on our calendar, and we look forward to doing many more of these in the future. Hopefully this has been well worth your time this morning. Thank you all very much.